Next, we turn to the discussant offering the policy perspective. Mr. Dennis Lapid is a director of the Monetary Policy Research Group of the Bangko Sentral ng Pilipinas Department of Economic Research. He's the product of the UP School of Economics. Please welcome Dr. Lapid.
Thank you. First of all, I'd like to thank the organizers, the ADB and the AIM, for inviting the BSP to this forum. I don't have a PowerPoint presentation. I decided to go old school and just read from a prepared text. I have 5 pages of notes, but I hope to keep to the timeline, the time limit. What I did basically for my presentation is just try to take the premise of oil scarcity and high oil prices as given, and then try to think through the possible implications for policy, particularly from the perspective of the central bank, and also largely in the context of the Philippines. So I focused mainly on the policy implications. Right. So, before I begin, I'd like to make clear also that the views I will express are largely my own and should in no way implicate the Bangko Sentral ng Pilipinas. So to begin, the projected period of oil scarcity in the global economy has a number of macroeconomic implications for emerging economies like the Philippines. The most obvious is higher inflation. Volatility in oil prices leads to cost push pressures on consumer prices, and persistent pressures create rising inflation expectations. And in the case of the Philippines, potential second round effects in the form of calls for minimum wage increases. Elevated oil prices also present a downside risk to output growth in the short run, although this could be mitigated by reduced oil dependence. In the case of the Philippines, the share of imported oil in the total energy mix has fallen to just about around 34% in 2010, from about 50% in 1996. However, crude oil remains a key input for the transport sector, and this serves as a key channel through which higher oil prices or oil price shocks are transmitted to the broader economy. Persistent increases in oil prices could also lead to a redistribution of income from oil importing countries to oil exporting countries, which could exacerbate global current account imbalances, and in the current environment, possibly drive capital flows further toward emerging economies, where, as we have seen, growth prospects in the medium term are likely to be much stronger. It is well recognized that increased capital flows help relax the financing constraints of many emerging economies. Stronger inflows tend to boost the external accounts, contribute to liquidity expansion, and bring down domestic interest rates. As long as capital inflows are invested productively, they can also enhance long-term prospects for growth, provided that they do not merely finance consumption and that financial stability is maintained. Foreign exchange inflows also help provide central banks an opportunity for reserve accumulation. Sterilized reserve accumulation is a common response to surges in capital inflows, particularly in the Asian region. Sterilization usually taking the form of open market operations, swap operations, and other forms of central bank borrowing from the banking system. A continued buildup of foreign exchange reserves enables policymakers or the central bank to respond to future capital flow reversals and smooth out exchange rate volatility. However, the reliance on sterilization must be weighed against the associated quasi-fiscal cost to the central bank. When sterilization proves to be too costly, a greater exchange rate flexibility can help mitigate inflows by prompting market participants to take greater account of exchange rate risks. In the event that surging inflows become persistent, policymakers will be faced with exchange rate liquidity and financial stability concerns. Under flexible exchange rates, capital inflows will lead to an appreciation of the nominal and real exchange rates. This will have an adverse impact on the competitiveness of exports and import substituting industries and result in a deterioration of the current account balance. The resource allocation effects of a real exchange rate appreciation may also spawn rapid credit expansion and asset price bubbles that could jeopardize the stability of the financial system. So the key challenge for monetary policy is to ensure that the additional foreign capital does not translate into inflationary pressures or asset price bubbles. So how do monetary authorities typically respond to oil price volatility? Monetary policy often has scope to accommodate the first round effects of any supply side shock. This is because monetary policy has relatively little direct impact on supply side pressures and works primarily through the demand side. Moreover, by the time monetary policy has begun to affect overall prices, the impact of the supply shock, particularly if driven by temporary factors, could already be in the process of reversing. Nonetheless, an uptrend in oil inflation can have strong spillover effects on the broader CPI basket. Given the possibility of second-round effects of supply shocks, monetary authorities may need to tighten policy settings preemptively to ensure that inflation expectations are firmly anchored. And this is what the central bank, the BSP, has already started to do. Back in March of this year, we've started to tighten on monetary policy, and we continue to have a bias towards tightening at present. Right. Communication is an important complement to monetary policy action in managing inflation expectations of the public. In the recent food and oil price shock, the BSP has scaled up its anti-inflation rhetoric to prevent the risk of perpetuating inflation expectations becoming embedded in the thinking of market players and also ordinary consumers. We strongly emphasize to the public our readiness to respond preemptively to second-round effects. Meanwhile, in the case of dealing with capital inflows, the main approach that the BSP has taken has been largely pragmatic, and our toolkit has included the following. Firstly, reserve accumulation and the associated liquidity management operations. Reforms in the foreign exchange regulatory framework to encourage outward flows,